Chapter 5 examples. So in Chapter 5, we talk about activity-based costing. And we're looking at activity-based costing as compared to a single or departmental rate for overhead application. So we have two examples that we're going to look at here. So in the first example, we're looking at a paint and flooring supply store that is having a negative revenue of their other flooring products line, and they're thinking about discontinuing it. However, their controller doesn't think that the single rate allocation that they're using at the moment is necessarily the best indicator of how resources are being used by these three product lines. So the controller has done some calculations and determined what activities we might have. So what we're allocating is the store support, order processing, receiving, and customer support phone calls. So when we look at this information, we have the activities, the use of activities, what the price per activity is, what their current sales and cost of goods sold are. They currently estimate store support at 24% of revenues. So that's their allocation rate under current methods. And they're looking at changing to an activity-based line. So what we're going to do is we're going to look at our current costing system compared to the activity-based costing system and see what new information we have. So we have for sales and cost of goods sold of our current lines. And if we take sales minus cost of goods sold, we get our gross margin. Then we are going to allocate store support costs, 24% of revenues. So we take our revenue amount times 24%. We're going to carry that all the way across. If we subtract that, that gives us our operating income. And then our operating margin is calculated by taking our operating income divided by sales. And as we see under this method, we currently have a negative operating income for other flooring products. And that is why management is considering dropping that product line, because it's currently not making money. Our controller has suggested that we adopt this other method of allocating those store support using activity-based costing. So the first thing that we're going to do is we're going to calculate what are our total costs for order processing, receiving, customer support. So we have each activity, and then we have the usage of those activities. So the first part of our analysis is exactly the same. We have our sales, we have our cost of goods sold, and we have our gross margin. So what we're changing is that support allocation. So for paint and supplies, we have order processing. When we come up here and we see that we have 425 orders times the rate of $140 per order. So we do that all the way across for all of our order processing. Carpet, 150 times our $140 per order. And for other flooring products, 100 times 140 per order. And now for receiving, do the same thing. We have 50 deliveries times $180 per delivery. And we will take that $180 rate times each product line's number of deliveries. And then the last thing we allocate is the customer service costs. So we have $18 per hour times half an hour for paint and supplies times 8 hours for carpet and times 3/4 of an hour for customer support. So we add those up and we get our total customer support. We take our gross margin minus our store support allocation to get our operating income. And then we take operating income divided by sales revenues to get our operating margin. So what we see is that if we use activity-based costing, our other flooring products is no longer operating at a negative. In fact, they're bringing in 4.67% of the income. We have a different allocation of costs. We use a little bit more for paint and supplies. We add almost $10,000 more for carpet. Or actually, it's total store support. We add a significant amount more for carpet. Our operating income has improved. So we're looking at using activity-based costing and how that changes the amount of operating income for a product line. Our second example does a very similar thing. We're looking at 3 products. We have A, B, and C. Currently, we're able to sell C at a higher price than what our target price is. Our target price is 150% of our total manufacturing costs. So we mark up at a rate, we take our total manufacturing cost times 150% to get our markup rate. So because we can sell product C at a higher price than the target price, and we're actually taking less than the 150% for product B, our CEO wants us to promote product C more aggressively. However, our controller doesn't really agree with that. Our controller thinks that we should look at using an activity-based costing system instead of a single rate system. So we're looking at what is our current cost using our volume-based method or single method based on amount of production, and then what is our amount under activity-based costing. So first we're going to look at our current system. So what is the total amount of overhead costs per unit and total overhead for each of the products? So we have right here, we have materials, labor, and then we're currently allocating overhead $510,000, and we use direct labor dollars to estimate manufacturing overhead costs. So we need to figure out what our overhead rate is for the year. So we currently have that it is $20 per unit to make product A, and we have 1,000 units. So when we're trying to figure out what our direct labor costs are, we need to add up the costs from each product line. So that's product A. For product B, we have $12 an hour times 5,000, or $12 per unit times 5,000, plus product C, $10 per unit times 500 units. So we add those up and that gives us our total labor costs for the year. So we use a rate of our $510,000 in overhead costs divided by our $85,000 in direct labor costs, or $6 per direct labor cost. Then we're going to allocate our overhead. So we have materials of $50, labor of $20, and then our overhead is our labor times 6 to get our overhead rate for product A, giving us a total cost of $190 for product A. For product B, we have direct materials of $114.40, direct labor of $12, and then our overhead allocation is the direct labor cost times our rate of 6. And for product C, we have materials of $65, direct labor of $10, and then our overhead allocation is our labor rate times 6. So we have our total costing. We're going to look at what is our current costing system. So what is our actual selling price? What is the product manufacturing cost? What is our gross margin? And what is our gross margin ratio for each product? So we have the actual selling prices up here for A, B, and C. So our actual selling price for A is $286, and for B is $255.60. And for product C, $310. Our product manufacturing costs, we just calculated in part 1. We have $190 for A, $198.40 for B, and $135 for C. Gross margin is sales minus cost of goods sold. So if we take our sales price minus our cost, we get a gross margin. And the gross margin ratio is our gross margin divided by the sales revenue. So if we look at this, our most profitable product currently is product C, followed by product A, and last, product B. So we're going to look at an activity-based costing system. And we've determined that we have 5 activities: setup, materials handling, hazardous control, quality control, and utilities. So we need to divide up our $510,000 by each activity, which we've already calculated. So now we're going to get what is our rate per unit or per item. So for setup, we're going to take our total costs divided by the total sum of setups. So if we have a $9,000 cost and 10 total setups, we will take 9,000 divided by 10. For materials handling, we're going to add 400 plus 250 plus 350. And we take that sum, we're going to divide the cost by the sum. Hazardous control, we take our total cost of $250,000 and divide that by the sum of our 3 product lines. We do the same for quality control and utilities. So now we have overhead allocations for each of our products lines based on the activity-based costing methods. What we need to add are direct materials and our labor costs. So now when we look at an activity-based costing system, we have our actual current selling price, our new product manufacturing cost under the activity-based costing, and our gross margin percentage under activity-based costing. So under activity-based costing, we would be losing money on product C, but we would increase the amount of gross margin that we are gaining on product A and product B. So we have now what is our target selling price under the activity-based costing method. So our new target selling price for A would be $321. Our actual selling price is $286. We would have to greatly increase the rate of product C. And product B, we would be about on par for what our difference in target price versus actual selling price is for activity-based costing. So we need to comment on these results and make a recommendation to the CEO based on this information. But we can't just take product costs under consideration. We can't just say, if we use the single rate, yes, we should focus on C, but if we switch to activity-based costing, then it's product B that we can put our attention to. We also need to look at our capacity. What is our strategy? What is the demand for products A, B, and C? So if we come up here, we can see that we produce 10 times the amount of product B. We sell 10 times the amount of product B versus product C. So we can't guarantee that just because we're currently making more money on product C, that we could increase the market demand for C to meet the sales of product B if we decided to discontinue product B and focus our efforts on product C. So we have to take a lot of things in consideration when we're making a management decision in addition to just the actual cost of those products.